Now, obviously you're hearing about inflation all the time, and inflation is measured by the Consumer Price Index. Most recently, that was over 8%. So the only tool that the Federal Reserve has to control inflation is to raise interest rates. The more they raise interest rates, the more they attempt to control inflation.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 98. In light of the recent rise in interest rates, I thought it would be a good time to talk about the difference between owning individual bonds and owning bond mutual funds. And in this episode, I'm going to talk about some of the key differences in what you should be looking at in your portfolio. As I mentioned before in past episodes, one of the most important decisions an investor can make with their portfolio is their asset allocation. And that is the amount of money that you allocate towards the more risky or growth investments, such as stocks, real estate, and commodities, versus the more income producing or safe investments, bonds and cash. And this will determine your potential upside and potential downside. And once you've determined that, one of the next decisions you need to make is the type of bonds that you will own. And if you're not familiar with bonds are kind of boring, right? They're not the exciting investment. People get a lot more excited about stocks or maybe even real estate. But bonds are an important part of your portfolio. If you're not familiar with bonds, I would suggest you consider going back and listening to episode 15, Understanding Bonds and How to Use Them. I go very in-depth about the different types of bonds that you can own, their pros and cons. I'll put a link in the show notes to that episode. You can go to retirewithryan.com and find the link to that episode. But to give a brief recap, there are three main types of bonds that you can own in the U.S. We're going to exclude foreign bonds for the sake of simplicity. That is corporate bonds, municipal bonds, and treasury bonds. Corporate bonds can pay the highest amount of interest, but also carry the most amount of risk. Then next you have municipal bonds. These also have varying degrees of risk depending on the municipality you're buying them from. And then you have treasury bonds. And treasury bonds are often considered one of the safest investments that you can buy. And those are issued by our U.S. government because the U.S. government has never defaulted on any of the bonds that they've issued. They always pay back their interest and principal on time. But regardless of which bond that you own or you're thinking of buying, one of the biggest enemies of bonds are rising interest rates. Bond prices and interest rates have what's known as an inverse relationship. They move in opposite with one another. As interest rates rise, bond prices go down. And as interest rates fall, bond prices go up. And currently this year, as measured by the 10-year U.S. Treasury bond, that is the 10-year U.S. government bond, and that is kind of the broad indicator for the bond market. And if we look at the 10-year U.S. Treasury, the yield that you could have gotten if you bought a 10-year U.S. Treasury at the very end of 2021 was 1.5%. So that's buying a 10-year U.S. government bond. That rate today, I'm recording this on May 18th, 2022, is 2.8%. So it briefly went above 3% before settling down. It had been a number of years before it had been that high. So chances are if you own bonds or bond funds, you've seen a decline in the price of your portfolio. And we've known for a long time that interest rates were going to rise, but no one thought it would be this fast. For years, our government has tried to stimulate our way out of the harm that was caused by COVID-19 economically, and they've pumped a lot of money into our economy, but there was little inflation. Now, obviously you're hearing about inflation all the time, and inflation is measured by the Consumer Price Index. Most recently, that was over 8%. So the only tool that the Federal Reserve has to control inflation is to raise interest rates. The more they raise interest rates, the more they attempt to control inflation. Now, this is great if you are an investor who's been sitting on cash in the bank for a while, because you probably up until recently didn't have a lot of opportunity to invest that cash into something with low risk and earn a higher yield. For example, you could now get a money market rate. You can find these online. I often recommend people go to a website like bankrate.com. You can find a money market rate around 0.7%. That's not great, but it's better than zero, which is what you would have found even a couple months ago before this rise in interest rates. You could also find a one-year CD paying you around 1.45%. Another option is that you could also consider I bonds. I talked about this a few episodes ago, But I bonds are government bonds that are tied to the consumer price index. And because we've had such a high reading in the consumer price index, the interest rate on I bonds has been very high. The interest rate for the next 6 months is 4.81%. So that's a way that you could buy a bond paying you a lot of interest, attempting to keep up with inflation. Though the negative about this, or I would say a difficulty, is that you can only invest $10,000 per person per year in I bonds. So a husband and wife could each buy $10,000 this year, but then you'd have to wait until next year to put an additional amount in there. And if you want to learn more about that, I'll also put a link in the show notes to that episode, episode 84, called Increase Your Cash Return with I bonds. So for the rest of your money, you really have two choices as to how you will own these bonds. You can either own bond funds or you can buy individual bonds. And I'll start first with bond funds. And there are many types of bond funds. And these are mutual funds. And you can buy them to target one specific area. If you just wanted to own municipal bonds, you could buy a bond fund that just buys municipal bonds. If you wanted to buy just corporate bonds, you can one that buys just corporate bonds or treasuries. You could also buy what's known as a tactically managed bond fund, where the bond manager is deciding whether to buy corporates or treasuries. They're making those decisions for you. Or, I'm a big fan of index funds. You could buy a bond index fund. And one of the important decisions anytime you're buying mutual funds, whether that be with looking at money in your 401k or if you have money somewhere else, you want to focus on the internal cost of the mutual fund, known as the expense ratio. And you want to focus on funds with a low expense ratio, because study after study has shown that that's one of the biggest predictors of your future success. Funds with high expense ratios tend to underperform funds with low expense ratios. It makes sense, right? If the cost to operate the company is high, more money is going to come out of your pocket to operate the company. So by focusing on funds with lower expense ratios, maybe even inside your 401k, that could also help you to improve your return on your bonds. Another thing that you can control is what's known as the duration or the length of maturity of the bonds that you're purchasing. And every bond fund has a number known as a duration. And you could look that up. I often suggest people go to morningstar.com if you're trying to look up a mutual fund, or you can go to that mutual fund company's website and you could look at the fact sheet of that mutual fund to find this number. So I'll just pick a fund that I sometimes use for clients. An example is the Spider Portfolio Aggregate Bond ETF. The symbol is SPAB. And this is a low-cost bond index fund that attempts to track the Bloomberg U.S. Aggregate Bond Index. And the Bloomberg U.S. Aggregate Bond Index is a measure, or a mixture, I should say, of treasury and corporate bonds. So it tries to diversify across the U.S. economy by owning both treasuries and corporate bonds. So it's an index that a lot of people cite when tracking the performance of their bond fund. And this fund costs 0.03% to own per year, so a very little amount, but it still has a duration of 6.38 years. So what does that mean? That means for every 1% increase in interest rate, this fund will see a decrease in roughly 6.38%. If interest rates went down by 1%, this fund would see an increase of 6.38%. So what that means is that, as I mentioned earlier, interest rates have risen this year by about 1.3, 1.4%. So this fund has declined in value by 9.63% year to date. You probably see the same thing if you own bond funds in your 401k, your IRAs. They've probably declined in value. So this is one of the negatives of owning bond funds, is their potential for loss in what's known as the net asset value of the fund when interest rates rise. However, this fund, just like one that maybe you own, continues to pay interest, and the interest as recently on this fund is 3.1%, as quoted by what's known as the 30-day SEC yield. That's a measurement that you want to look at anytime you're looking at the interest a bond fund is paying, because that looks at the last 30 days of interest. However, it's still down 9.63%. But if you reinvested the interest, it would be down less. For this fund to see its net asset value go back up, we'd need to see interest rates go down a similar amount. Now, the Federal Reserve is indicating that that's not going to be the case. They're indicating that they're going to keep raising interest rates this year, kind of irregardless of what happens in the bond market or the stock market, because their primary mandate of the Federal Reserve is to have maximum employment in our economy. And they're trying to make sure that we continue to do that, and they're trying to control inflation. So one of the things you could do within your portfolio is that you could shorten your duration. If you believe that interest rates are going to keep rising, the Federal Reserve is going to keep raising rates, then you could buy bonds that have a shorter duration, a duration of maybe 2 or 3, a short-term bond fund, maybe go in a money market. And this would help protect your bond portfolio from further declines in value. The trade-off would be that you'd be getting less interest, because most likely that short-term bond fund or money market is going to pay less interest, an intermediate-term bond fund would. If you happen to own a long-term bond fund, a duration of 10 or maybe even more, you'd really want to consider cutting back on that fund because that fund is probably down even more. That fund could be down approaching 17, 18% year to date. So it's something that it stinks, but you want to maybe think about cutting back for now until you think maybe interest rates are going to go down. And then if you had a good idea of that, you could then buy that longer term bond again, because that would actually go up in value when interest rates go down. Though predicting interest rates is almost just as hard as predicting the stock market. It is not an easy thing to do. So just to recap, some of the positives of owning bond funds are greater diversification, because it doesn't take a lot to buy a mutual fund, usually $500 or $1,000. You've got great diversification. You've got access to institutional pricing because the mutual fund management company is out there negotiating on your behalf for whatever they're buying to try to get the best price. And you also have the benefit of professional management. However, the negatives are increased management fees, potentially depending on the bond fund that you own, greater fluctuation in the NAV with the market, as we discussed earlier, and you lose a little bit of control over the cost basis and tax consequences. If you wanted to just sell certain bonds that were at a loss, you don't have that luxury. You'd have to sell the whole fund. So an alternative to owning bond funds is owning individual bonds. That would mean that either on your own or with the help of an investment advisor, you select the individual bonds that you would buy. And this could be a combination of corporate and treasury bonds if we're talking about retirement accounts. If we're talking about money investing outside of your retirement accounts, if you are in one of the highest tax brackets, you could consider purchasing municipal bonds. And these are decisions that you would have to make as to the types of bonds that you want to buy and the allocation based off your individual risk tolerance. But to give you an idea of where interest rates are on three types of bonds, I looked up what a corporate bond was paying. A triple B corporate, you could get a 2-year paying about 2.6%, a 10-year paying 4.4%. For a 2-year treasury, you could get 2.5%, a 10-year is paying 2.8%, and a municipal bond, a 2-year is paying 2.3%, and a 10-year is paying 4.15%. So you can see that if we're talking about treasuries, you're not getting rewarded a whole lot for buying a longer-term treasury. You could buy a 2-year treasury earning you about 2.5%, and this is actually one of the things that I've been doing with some client portfolios is buying some short-term treasuries to take advantage of this higher interest rate, because there's very little risk with doing this and you're getting a decent interest rate by buying this. So one of the main benefits of owning individual bonds is that even though your bonds may decline in price after you purchase them, if interest rates rise, if you don't sell them and you hold them till maturity, you won't have a loss. So let me give you an example. Let's say you went out and you bought a 2-year U.S. Treasury bond for $1,000 and it's paying 2.5% interest, as I mentioned. And in 6 months now, the same 2-year U.S. Treasury is paying 3% interest. The value of your bond you bought would be worth less than $1,000 if you wanted to sell it on the secondary market. But if you held it until it matured, you would get back the full $1,000. That wouldn't be the case if you owned treasury bonds inside a mutual fund. That bond NAV, net asset value, would stay down until, as I said before, interest rates went down again. So that's one of the biggest benefits, is that you have more control over how you get back your principal, and you also have the ability to select exactly what you want to buy. However, if rates do rise and you buy short-term bonds, you're potentially missing out on a higher interest rate. If you want to purchase individual bonds, chances are you can't do them through your 401k unless your 401k has a brokerage window. So you'd need a brokerage account, opening one up with Fidelity, Charles Schwab, Vanguard. These are some of the big broker dealers. And from there, usually they give you the ability to buy any type of bond, treasury bond, corporate bond, or municipal bond. But one of the downsides of owning individual bonds is that you need more money to get greater diversification. Most bonds trade for values of $1,000 or $5,000 just to buy one bond. So that if you don't have a large retirement account, it could be difficult for you to put together a diversified portfolio. You'd probably be better off maybe using a mutual fund. Additionally, when you buy individual bonds, there's usually what's called a markup by these brokers, essentially a small commission that they add into the bond that you're paying for. Whereas if you are owning bonds through a mutual fund, the mutual fund manager most likely would be able to negotiate that a little bit lower because of the large trade volume they're buying. So the benefits of buying individual bonds are predictable value at maturity. You have your own cost basis so that if you want to sell one bond that's at a loss, you have the ability to do that. And you can also set up your portfolio to pay reliable income based off the type of bonds that you want to buy. Most individual bonds pay interest semi-annually, twice a year. So that could be a negative, that if you're only getting interest payments twice a year, whereas most mutual funds pay interest on a monthly basis because they have a mixture of funds in there. So I hope this sheds some light on the pros and cons of owning individual bonds as compared to bond mutual funds. And just keep in mind what might be best for you may not be best for someone else. And you really have to assess your ability to manage your portfolio and have the time to stay on top of it if you're going to own individual bonds. And also if you have even the desire to manage that. If not, then maybe mutual funds might be a better fit for you. If you're enjoying this podcast, please subscribe by going to your favorite podcast app and subscribing. Or if you're listening to it on Apple Podcast or iTunes, leaving a review would be greatly appreciated. So thanks for tuning in this week. I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.